I want to show you what happened to my investments that I've hardly touched for 20 years. You might assume that they've performed poorly since I wasn't actively managing them. But no, that's not the case at all. Stay tuned. I love how friendly the Vanguard website is. I think I'm feeling very positive towards it today in particular because I logged on and I saw this. My traditional IRA, which is an American tax-advantaged retirement account, at Vanguard, which is an American investment management company, is valued at over $60,000 for the first time ever. And you might think that's not a lot of money for a 45-year-old like myself to have in their retirement account. But in this video, I'm going to tell you why it is and why I'm surprised that there's even that much money in this account. I'm Susie, I'm American, and I've been living and working in France for over 15 years now, which means that I haven't been able to contribute anything to my traditional IRA in that time. So what I think is really incredible about this account is the growth, not necessarily the amount or any of the details, but really how much it's been able to grow while I've just left it alone for the past 15, 20 years. Originally, this was money that I invested in my 20s, mainly between 2002 and 2004, and maybe a little bit between 2007 and 2008. These were the only times I was living and working in the US as an adult, so it was the only time that I was eligible to contribute to my traditional IRA. And I haven't invested anything since May 2008 because I've been living and working in France since then. So how much did I originally invest? Well, I seem to remember that it was about $16,000 invested over those periods of time when I was living in the States. Today, I can go back up to 10 years in the past in my Vanguard account information, but I don't know how to access the historical data from my account. But I seem to remember that it was about $16,000 total. Basically, when I was younger, I was living and working in the US. I had a really measly income. I was in grad school and then I was working for a nonprofit, but I'm pretty frugal and I did manage to accumulate some extra cash. And because I was worried about paying a lot of income taxes, I was trying to figure out a solution, trying to figure out a way that I could lower my tax bill. I literally just went to the bookstore and bought a book called Investing for Dummies. And this is the cover of the 2002 edition, and that cartoon guy looks pretty familiar, so this might be the exact edition of the book that I had. And I just read it and did what it told me to do, because I was definitely an investing dummy. And it said to open an IRA and to invest in low-cost mutual funds. I obviously didn't have the resources to hire a financial advisor. YouTube didn't exist. Nobody that I knew was talking about these issues. So this was my one source of information, and I literally just did what it told me to do. I have the information here about the performance over the last 10 years. So you can see the initial balance was already about $25,000. So this is already a significant increase over the approximately $16,000 that I originally invested. And you can see $0 in purchases over this period of time. And the ending balance is over $60,000 now, which is an annual rate of return of 9%. And I think it's just incredible to consider that the value of this account has increased by over $35,000 when you consider that I haven't contributed anything and that I've barely done anything to this account over this period of time. These are the investment returns for the last 10 years. So as you can see, there have been ups and downs. So for example, the downturn in 2020 because of COVID, which now looks relatively insignificant compared to the big market downturn in late 2022. But for me, this is a retirement account. I'm invested in the long term. I can't even access this money until age 59 and a half at the very earliest. So my plan is just to stay invested for the long term, to try not to worry too much about the short-term downturns and focus on the fact that historically the market has continued to increase, to go up over time. So I'm just going to stay invested for the long term. That's my plan. I hope to be able to take advantage of long-term market growth. So what did I actually invest in? Well, first I had to open the IRA like the book recommended, and then I had to choose specific funds to invest in. My main investment now is VTSAX, which is a low-cost, passively managed index fund, which provides investors with a broad diversification across the US market. The expense ratio for VTSAX is very, very low at 0.04%. Meaning that gains are optimized in a sense because they're not being compromised by having to pay a lot of fees. VTSAX is a mutual fund and an index fund. The equivalent ETF exchange-traded fund is VTI, which is also offered through Vanguard. I don't have access to these Vanguard products through my French investing accounts, but I do have access to S&P 500 ETFs, which broadly replicate the performance of the American market as well and are a good alternative if you're looking for something that replicates the American market's performance. Here is one example of an S&P 500 ETF that as French investors we have access to. You can see the expense ratio 0.15% is higher than the Vanguard funds, but still relatively low. And this one is also eligible for the PEA, which is also an advantage, which I'll talk about more later. But if you're interested in learning more about the S&P 500 ETFs, I have another video that I'll link to in the description below, so you can check that out as well. At the beginning, I was invested in more funds than what you just see here. I was invested in one called the Wellesley Income Fund, one called Windsor 2. But as I learned more about performance and expense ratios, I migrated more and more of my funds into VTSAX over time. So now you can see it makes up the vast majority of my investments here. And I have a little in this target date fund as well. The idea with this fund is that as the target retirement date approaches, that the composition of the fund will slowly shift over time to focus less on stocks and more on bonds. And here's the asset mix for my portfolio overall. So 95% in stocks and 5% in bonds. Since VTSAX covers the American market, I also have a little bit invested in VTIAX, which is an international index fund for a little bit of geographic diversification. Should I have more invested in bonds? Conventional wisdom and some advisors would probably say yes because of my age. But considering my personal profile, this is the allocation that works for me for now. I'm not really risk averse. I have a pretty long-term horizon here. And also volatility doesn't really bother me too much. That's not to say that this allocation won't change over time. It may, but for now, this is the allocation that works for me. But I really did not want to get bogged down in the specific details of the type of account or the specific funds that I'm invested in, because that's not the main point here today. Really, what I wanted to show you is what can happen if you invest early in low-cost index funds and you just leave your money in the market. Have you heard about the Fidelity study that found that the investors whose portfolios performed the best were those who had forgotten their passwords? I never literally forgot my password, but sometimes I behaved like someone who had, because there were years there where I just did not touch this account, and look what happened. I think I basically did nothing to this account between 2008 and 2020. And that's when I sort of started to get interested in investing again, and I kind of learned more about expense ratios and fees, and I tried to optimize this account a little bit, which hopefully has had a relatively positive impact. But just the fact of being invested over that long period of time is really what's mattered, I think. In Morgan Housel's amazing book, The Psychology of Money, he says, if you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. And by investing in my 20s, that's what I did. And I was lucky to have chosen low-cost index funds, which allowed my money to grow without being held back by fees. So is this a life-changing amount of money? No, not necessarily, but it's definitely reassuring that it's there and it will continue to grow. If I just leave this money in this account and it continues to perform the way that it has, which of course is not guaranteed, then 15 years from now, I'll have over $200,000 in this account. If I leave it until I'm 70, I could have over $500,000. This is the power of compound interest. What will I even do with that money? I have no idea. How will I access it if I'm living in France? I really don't know. I'll have to figure that out at a later date. So when I moved to France, my focus shifted to other things. In our 30s, for example, we bought and renovated our house. We had kids. And we weren't actively investing for our retirement, really. And around age 40 is when we sort of had an epiphany and realized that we sort of had to get going in terms of retirement investments. Again, for me, considering that I had started in my 20s a little bit, but we started actively investing in rental real estate properties. And then I also opened up a PEA, Plan Épargne en Action, which is not specifically a retirement account, but it's a tax-advantaged brokerage account in France. And I have been really making an effort the past couple of years to invest in my PEA. And I have an exciting threshold that I'm about to cross for my PEA as well. And I'm planning on making a video about that soon too. And my husband has a PER, Plan Épargne Retraite, which is also a tax-advantaged investing account, but specifically for retirement. And so it's more similar, I guess, to an IRA in the US as well. And so we are now actively investing for our retirement and making a little bit of progress, which is reassuring, of course. So my advice to you is, no matter your age, no matter where you are in the world, if you can, start investing now in low-cost index funds. Morgan Housel also says in The Psychology of Money, good investing is about earning pretty good returns that you can stick with for the longest period of time. That's when compounding runs wild. One last quote from the book. Housel also says, one of my deeply held investing beliefs is that there is little correlation between investment effort and investment results. Absolutely. I've put in zero effort here, but thanks to optimizing for low fees and time, I have had great results. This just goes to show that investing doesn't have to be complicated or scary, and that, in fact, passive and boring is actually a great approach. Check out these other finance-related videos and subscribe if you're interested in this kind of content. Thank you so much for watching, and a bientôt!